with James. A bunch of you people have spoken with him before, and he's going to give a background of himself, but just kind of, let you guys know. He closed on a property yesterday. I tried to get in as a passive investor, and it filled up within hours. So it was a great deal. So the people that invested are going to be pretty happy. The deal in San Antonio. So James, why don't you? I made it so you can present your slides.
Sure. I can share it, right?
Yeah. Why don't you push out your slides and get started?
Can I see this?
Yeah.
Okay. Can I start?
Go for it. Thanks, James.
All right. So, hi everyone. James Kandasamy from Achieve Investment Group. Just to introduce ourselves, my wife and I, we run the show. We have like 2,000 units right now. We are single GP operators, right? So it's only me and her, and we have our passive investors, right? More than 100, maybe 150, maybe 100, after closing yesterday, 2,000 units, 10 apartments, $50 million raised, maybe 300 investors. We are also vertically integrated asset construction and property management. We have like 40 employees working for us, author of best-selling book, which I'm going to share later on how to get it for free if you guys want to go and do it. Don't think this is a passive investing means now you know everything in investing, right? There's a lot of advanced concept in that passive investing book that you'll be surprised that you do not know, right? If you're a new person who are learning how to syndicate deals, who are new in the business, you want to understand how passive are being educated because passives will get smarter after reading this kind of book. And I'm actually writing another book which is called Advanced Passive Investor. They're going to be a lot more smarter than a lot of sponsors. I can bet you guys that once they read that book, right? So I'm also have a multifamily investors group in Facebook. And also, if you guys a lot of you are underwriters, sponsors, you would love this podcast. It's called Achieve Wealth Through Value Real Estate Investing Podcast. It's not a marketing fluff podcast. It's a bit technical, right? Because I go a bit more deeper into the people that I bring on, and sometimes I have problem bringing the right person because we go deep into it, right? So I also have small mentoring program for active and passive investors. We won the Apartment Association award for 2017. It's not easy to win a property of the year award because there's a lot of big companies, like Greystone, Blackstone, all kind of stone property management company, which is very big, and they do very well as well. But if you're able to win it, that's a big thing. I'm also a CCIM. I also have my own designation on CCIM, which is considered black belt in commercial real estate investment, right? So these are our org charts. We have like 40 employees from asset management, property management. We also have our construction arm. We also have our education, and we also have a Chief Cash Foundation, which is a non-profit 501c3 organization, which we filed with IRS maybe 2-3 weeks ago. Hopefully it'll take like 2 months for it to come back for approval. This is my book. We have like 70 right now. Today I checked 75-star reviews. There's different people give, as I said, I mean, if you have, I'm going to be offering this for free at the end, and pay the shipping of $4.95. This book is it's $20 in Amazon, the same book, right? So it is a bestseller. It's ranked a top 15 real estate investing book by Jim Cramer, The Street. This is my Facebook group, my podcast. This is my courses. I mean, this is my deals. I didn't add the new deal because that's so new, right? So this deal we sold like February of this year. We made like 332% in 4 years for my investors. Not overall deal. Okay, this is my investors, how much they make, 50% IRR. This one we refinanced in 12 months. We pulled out like 117%. This one we refinanced not in 12 months, but in 15 months we refinanced 80% out. All these are cash flowing. It's holding on well during COVID as well. Okay, so let's go to IRR. What is internal rate of return? So I'm sure you guys have heard about IRR. It's very, very commonly used. People just throw IRR, but it's very, very poorly understood because, sometimes you need a lot of theory behind IRR to understand. I'm not intending to cover all of the theory because it can be a very mathematical class, right? But I'm going to try to explain it in a very layman terms on what is IRR is and how you can use it, right? More application of IRR is more important for me than understanding what is the math behind it, right? So if you have seen a lot of people say that, wow, this is like 17.83% IRR, that's impressive. Well, what does it mean, right? So normal passive investors doesn't know, and sometimes even sponsors doesn't know as well. So, but it's good that you all are learning here, so that at least you can really understand what exactly is IRR and how it can impact an investment. How can you use to make that decision, right, on investing, right? So I want to give a very, very high level concept of time value of money, right? So as you all know, our money grows throughout the time, right? So whatever future value of money, like say value of 20 years down the road, the $1 would be equals to present that $1 plus whatever interest you're getting every year, right? So basically future value of money is FV, right? So whereas present value is PV today, and whatever interest you're getting in certain years. So basically what we're saying is you have a value that is increasing, your value of that money increasing throughout the year. But if you roll back that money from the future back to now, the money is going to be valued less, right? So because present value is always future value of money minus the interest, right? So this is a bit more detailed. So if you look at IRR is the so the high level definition, I'm going to go slowly into this, but IRR is the interest rate, which is net present value of all cash flow, both positive and negative from the project of investment equals zero, right? So it used to measure how attractive is a project. For example, if you're looking at a deal where that doesn't cash flow for 2 years, like development deal compared to a deal that cash flow 10% per year, and you look at overall investment in a development deal and in a cash flowing deal, how do you make decision, right? Which one is better, right? So that's where IRR comes in, because IRR will measure what's the time value of money. And let me just go to the next slide quickly. So if you look at the metrics that we have, different metrics we have cash on cash, which measures the cash flow, whereas annualized return will measure the cash flow plus the refinance and sale. Equity multiple is cash flow refinance, but IRR will have cash flow refinance and also time value of money. This table is directly from my book, so you guys can see it. But basically, there's a very simple high-level overview of why IRR is different from all other metrics, right? And why Wall Street of commercial real estate loves IRR, because that's how they analyze deals, right? They don't analyze deals cash on cash, analyze equity multiple, double digit, and all that. It doesn't fly with the big guys, right? The guys who are really, really super sophisticated. So let me go back to here. So how IRR is calculated, right? So remember I mentioned here, right? So future value of money equals present value plus interest in certain years, right? So basically future value of money, let's say you're getting, it's this analysis called a discounted cash flow analysis, right? So the discounted cash flow analysis basically takes the future value of money by year. So let's say next year you get future value of year one. Then second year you get future value of year two. And then third year you get future value of year three. So that's called yearly growth of your money, right? Whatever money you're making in the next few years, right? And you try to measure, you try to take, so what it does is takes the present value of all the future value of money and bring it to present value. So if you see here, what happened here is, if you see this P0, P1, P2 is actually what the cash flow that you're getting. And what they're doing is that they're adding all the cash flow that you are getting in the future years and try to bring it to current year and to make it zero, right? So, and the reason why they do that is very simple, right? So if you have an investment opportunity, let's say you have a CD, right? If you can say those days CD in the bank used to be like 15% CD or 8% CD or what, right? So do you want to invest in a CD or do you want to invest in a multifamily which gives a 7% return, for example, right? So of course you're going to invest in a CD, right? Because CD has a higher rate of return, right? But CD is fixed. Every year, you're getting a fixed amount. But multifamily investment can go up. One year can go up 10%, one go up kind of 6%. The others can go up 7% and all that. But the IRR measurement, when you bring all that cash value into the year zero, which is today, and you see the amount, is this a good investment for my money? Because you're looking at from today to the future, and the rate, the IRR percentage that's given is basically comparing all your options. So option A is invest in a CD, you get 10%. Option B, you invest in a multifamily, you get 8% return, right? So option C is invest in a development, you get 20% return. So, and the returns can be different, but IRR will neutralize all these different types of investment into one number, which is brought into today's value, right? So does everybody follow? I can show you more examples. So I don't want to make sure everybody's still listening, right? So
I'm with you.
okay, good. So I'll show a bit more tables, so at least you guys can understand on how it works, right? So if you look at P0, P1, P2 is all equals to cash flow, proceed 1, 2, 3, 4, right? Every year there's a cash flow, and then they bring it all to current year. What is the value? If you add up all that cash flow, how it becomes zero? That's the present value that they're trying to calculate, right? So let me look at a table here. Okay, so before we go further, I want to go into the application of IRR. I know I talked about, let me see whether I have a, I want to show it. Okay, so for example, this one, right? So if you see deal number 1, you have a year 1, 7,000, year 2, 7,000, year 3, 7,000. And then at the end, you have 48,000, right? Whereas, so the IRR is calculated based on all this amount, 7,000, 7,000, and then it took the back end, and then they bring it to year 0, right? So, okay, so if you see here, right? So for example, 7,000, but the present value of 7,000, even though in year 1, the present value of 7,000, which you get at the end of the year, 7,000, when I bring it to today's value, it's only 6,152, right? The second year, the 7,000, because it's 2 years down the road, that 2 years down the road, the 7,000 that I'm going to get 2 years down the road, I'm bringing it to today's value, which is PV, present value, right? It's only valued 5,406, right? Same thing, the amount that you get on the last year, right? Year 10, 7,000, that 7,000 year 10 is equivalent to 1,923. So it's basically taking all the value that you get in the future, you're bringing it to today's value, and you are measuring that, right? That's basically what IRR measures. What is the future value of all this money to today, right? So does that make sense? Before I go into this a lot more slides on application of IRR. So okay, I want to stop for a while. So I want to make sure people have any questions before I go into the application. Any questions? Or is it too complicated or too much?
Well, how do you calculate the, like, what $7,000 is? Was it 70? I forget the number, but how do you calculate that 10 years
So you
out?
use an Excel function, PV function.
Okay.
So let me see whether I can show you guys or not. So let me see here, right? So.
And I assume that's based on inflation. Am I correct with that?
No, it's based on a discounted rate. So for example, let's say you are saying a discount rate of 8%. That means what you're saying is I can get that 8% for this year. So basically you take 7,000, that's the FV, right? And then you put 8,000 discounted rate, you bring it to today value of 7,000, right? So if I open a Excel spreadsheet, let me see here. I'm trying to see how do I explain this. So how do I show it in an Excel spreadsheet? So if you look at any Excel function, can you see here?
Okay.
And FV of PV2 here, right? So you can add the rate that you're putting in, and then you're putting in how many terms you're looking at PV, right? So let's say you're looking at 10 terms, then you put 10. If it's a year, I mean, you want to change it to yearly or you want to change to monthly. Yeah, usually they go by, I think mortgages go by yearly, by annual, by monthly, sorry. And then what's the payment that you're paying and what is the future value here, right? So you basically works to what you get on the FV, right? So if you go into, let me share one more thing. So hold on. That's a really good question. If you're going to see what is the amount that you can get, let me look for my IRR partitioning. Okay. Okay, so if you can see here, right? Let me show you guys here. Can you see this?
Yep, got it.
So basically, if you see that, that's 5,000, right? So when you put to PV, so if you see this value, PV equals to C7, right? C7 is this, right? So C7, let me see here. So what is the rate that you're getting? This PV function is basically looking at what is the amount of money, even though it's happening in the future, you're looking at it today, right? So with the rate of 13.8 and you're getting a B15, right? So B15 is this, right? 5 years from now, and you are getting C15, right? So 5 years down the road, what is this 5,000 valued if you discount it back at 13.8%? So that's, right? Does that make sense?
Mm-hmm.
Yeah, so that's how they measure PV, right? So as I said, the time value of money is basically, there's a lot more theory behind it. You know, there's a lot of more way to calculate it, but this is, I'm just showing a simplistic way in Excel on how you can calculate all this, right? So basically, let's say you have a $5,000, sorry, $5,000 here, right? And then you can see it's only valued at 3,859, right? So every year, even though you're making like whatever money, let's say you're making $4,000 on here, but it's only valued at 2,300 in today's value. That's
Today's
present
dollars.
value. Yes. So all these are today's value. You're basically bringing all the future cash flow to today's value and see that if I want to make a decision today, right? This is day zero, right? Today I want to make a decision, and people are claiming all these big numbers in the future. How do I take all that big numbers in the future to today's value, and I want to make an investment decision? That's the meaning of IRR, right? So if you have an option of choosing between a 10% IRR versus a 12% IRR versus a 9% IRR, of course you're going to choose with the biggest number, right? Because, but the thing is, these three options could be, one is development, one is land, one is maybe multifamily syndication, one is maybe CD, right? Everybody's talking about cash flows at different amount, different time, but the IRR is able to bring everything into one place and able to measure the what is that percentage that everybody's talking about in one single number at day zero.
Hey, James, just have a quick question. Is this a real investment that has 5 years of no cash flow, or?
Oh yeah, absolutely. There are a lot of if you go and do what you call development. So development will take, let's say you're doing a loan right now, right, on a development, right? Zoning, rezoning, first year zero is gone. Then after that, you do 2 years of construction, right? So that's 3 years is no cash flow, right? And then there's another 2 more years of lease up. There's 5 years you got zero money coming in. So it's absolutely possible.
Okay, so this was a development you were looking at.
Yeah, well, I'm just giving an example.
Yeah.
We're going to go through. We're going to go a bit more detailed example in a short. Can you guys see this PowerPoint? Or maybe that's not, I guess. Okay, so I'm going to go a bit more deeper right now because you can see so first of all, remember I talked about different IRR and different investment, and you are bringing at day zero and you're trying to decide what is the best IRR. But for you to choose investments, there's also a little bit more detail that you can go, where you can split between cash flow and also the sale of investment. Because if you look at this, if you guys look at this, if you look at investment return, so it's always in any investment, there's purchase of investment, there's operation, and there's also sale, right? But for example, all the cash flow that you're getting in operations is always higher value compared to sale of investment, because the further you go out on year one towards year 10 or what, right? The less likely that you're able to predict what's happening. So this operation cash flow is always higher value compared to the investment sales. right? And this is always lower risk return. Cash flow is always risk return versus sale is always high risk return, right? So, and this is basically because based on current income projection, this one depends on exit cap rate, which you never know what's going to happen in the next 5 years down the road, right? So if you look at risk adjusted return, it's always a spectrum, whether the lower risk high return is always is high risk adjusted return, right? Whereas if it's high risk low return, it's always low risk adjusted return. So risk is a key function when you look at any investment, right? So it's not like I'm going to go through why the IRR is just not one measure to look at, right? So one way to look at it is when you take that IRR and you partition into two. One is cash flow, the other one's part of equity appreciation. And whenever there's a cash flows, a lot more cash flow, let's say 70 to 100% of that IRRs come from cash flow, whereas equity appreciation is less, 0 to 30% equity appreciation is always low risk, right? Whereas the other way around, if cash flow is low, let's say you're doing a lot more deep value add where there's a lot of bang on the equity appreciation, it goes into higher risk deal, right? And it's not to say you don't do high risk deal. You absolutely can do it. You just have to make sure the return that's being projected on the high risk deal is much, much higher, right? So let's look at this method called IRR partitioning, right? So what to do, you basically look at cash flow versus sale assumption. And how you do it is basically you convert the cash flow to day zero using present value function in Excel, right? So this is deal number one, deal number two. And if you look at it, even though deal number one have 7,000 cash flow from day one, and at the end there's 48,000, whereas deal number two doesn't have any cash flow. Like for example, remember I talked about development deal, right? There's 5,000 only coming in year 5, but they have a big upside of 140,000. But looking at the IRR, it's the same, right? So because the backend is more backend skewed, this IRR is saved by the backend, whereas here it's saved by more by the cash flow. So the IRR is the same, but the risk adjusted return can tell the difference. The risk adjusted return on this is much higher compared to here because of this. So for example, deal number one, deal number two, it's the same thing. Just now we talked about PV, right? Present value. So you take all the cash flow, you bring it to year one, and sale, you split the cash flow with the backend upside. You split the cash flow versus backend upside. And if you look at on deal number one, the IRR that you get on all this PV is 74%, right? Of the IRR of 13.8%. Whereas on backend is 26%, right? Whereas on this deal, it's the opposite, right? You get less money on cash flow, but more money on the sale of the backend, right? But here, because you're banging a lot on the backend, your risk goes up because you do not know what's going to happen 10 years down the road. Even though the IRR is the same, remember just now I showed you guys the IRR is the same. These two deals, IRR is the same, but because of it's not separated between cash flow and the sale. And when I look at it, right, here the cash flow is lower value on deal number two. Here, cash flow is higher. 74% of the IRR comes from the cash flow. Here, only 23% of the IRR comes from cash flow, right? So the deal number one has higher risk adjusted return. This is much better deal because when you look at the risk, it's much lower, but it gives the same deal, right? So I think that's it. I mean, hope I made sense to everyone. So let's go for questions. I think there was one question, but I think it went out or what, right? So any question?
So there was a minute there where you pulled up a formula and it was basically showing P0 plus P1 over IRR plus P2 over IR1 plus IRR squared equals 0. And that was what IRR equals. Now, P0 in that case should be a big negative number. That's the price that
correct.
That's your investment, right?
Correct.
Okay.
Yeah, correct. Because if we look at IRR, the way we calculate is cash flow in, cash flow out, right? So let me share you guys something. I'm gonna cash flow in, cash flow out, right? So for first year, you're basically putting a big amount of down payment, right? Say you're putting $5 million into the deal. So that's negative $5 million. And then you have a lot of cash flow for next, let's say 10 years investment, and at the end you're making money back, right? You are basically making profit, right? So maybe from 5 million become 10 million, right? So the first one is always negative, and then after that positive, 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 everything else is positive, and that should be coming back to year 0 to show the IRR. Any other questions? I know there's a lot more, time value of money. I mean, there's a lot more theory behind it, and it's going to be very tricky to explain it in a 1 hour meetup, right? But at least I think what you guys should take away from this presentation is if you can partition the IRR into 2 using the PV function on the cash flow and on the back end, you can analyze the deal based on risk, right? Because cash flow is always higher value because it's more predictable. Right? When someone talk about, oh, this guy gave me 20% IRR and the another guy 20%, I cannot decide which one is better. Then say that, okay, now let's go and see, are they making, how many percent of that 20% is coming from cash flow? How many percent of that 20% is going in the back end, right? Because exit cap rate is, no one knows, right? So no one knows. Everybody predicted the interest rate to go up, but interest rate went down. And because of that, a lot of people lost a lot of deals. Because people are putting very high exit cap rate. So a lot of people cannot do deals. So you can't predict the exit cap rate, but if you can predict cash flows, you are going to be making much better decision in terms of which deal to invest and which deal is lower risk.
Hey, James, I have a question.
Sure.
So your deal that closed yesterday, right? Is it more like a deal 1 or more like a deal 2 where it's a heavy value add and where it doesn't really cash flow for the first 2 or 3 years, and then you're banking on the sale in years 5 or 7 versus, deal 1 where cash flows and there's minimal deferred maintenance, just getting the cash flow?
Yeah, mine is a deep value add. I mean, the cash flow was not really there for first year. I think it's like 1 or 2%.
Mm-hmm.
Second year, we go back up to 8%.
Mm-hmm.
And our loan terms, remaining loan term, because it's a loan assumption, is I think 7 years, right? But on year 3, I'm taking out 70% of the money out because of refi, because of supplemental loan. So because of that, it becomes very, very heavy cash flow centric because it's everything coming on the front end.
Gotcha.
Right.
Okay.
So that makes a huge difference in any deal. When you're able to refinance very quickly,
Sure,
your risk reduce a lot, right? Because now only 30% of the investors' money and the deal, so their risk has become really low.
right. Now, is that your acquisition criteria going forward for the next, let's say, 1-2 years in this current environment? You're looking for deep value add, or are you looking for more of a cash flow play? I know you're in Texas, so
yeah. Well, I never buy deals on just cash flow because it's very high risk.
Yeah.
And I'm going to explain in a short while. So I only look for value add deals. Deep value add, if it's really, really deep, because sometimes they put deep value add, but the price eats up all your deep value add. What's the point of doing it?
Sure.
Right? So,
right. Yeah.
So no point of doing that kind of deep value add. It's a waste of time. So I like to look at value add, but I like to look at value add from day 1 itself.
Yep.
Right.
Gotcha.
So I always look for built-in upside, which means today itself, there's already a inefficiency in management,
right,
inefficiency or rent, right? That's what I look for, right?
Gotcha.
So,
okay.
But if you guys are just starting up, I mean, cash flow is okay. It's not a bad deal at all. You could absolutely can do it. But just remember, when you do a cash flowing without value add component, you are very, very close to your debt service coverage ratio, right? So if you're doing if you get qualified for a loan at 1.25 DSCR, and next year you're only increasing 3% rent growth, your DSCR go from 1.25 to 1.26 or maybe 1.27. That's it, right? And then maybe the third year you got another 3% rent growth. Maybe your DSCR go to 1.3. So your the buffer from what you need to pay your lender versus how much you're making is very, very small. So let's say the economy tank. I mean, right now, of course, the economy didn't tank so much for multifamily people, but in case it tanks, it can drop very quickly to below 1%, right? But if you have a deep value add, you can build your buffer from 1.25 DSCR to maybe 1.3 in the second year, and then go to 1.5 because of your gap from what you're going to pay for your lender. You separate them very, very high. So you have a lot more buffer. So you're going from high leverage to low leverage because your DSCR is huge, right? That's the reason why people do value add, so that the lender becomes a small equation. When you're just doing just a cash flowing deal, I mean, a lot of people say, oh, it's just cash flow. What's the problem, right? But it's okay as long as the market's good, right? So, right. But I don't know. I mean, sometimes we look at a lot of risk. As I said, past 10 years, everything has been good. People don't look at a lot of detailed stuff. But I think risk is something that you want to look at when you're underwriting deals.
James, how are you underwriting the exit cap rate? I mean, this deep value add obviously is a little bit different, but just kind of on a standard value add, with the expectations that interest rates are going to remain low for the next couple of years.
So that's a really good question, because everybody said that at 50 basis point, you add 100 basis point, right? Yeah, that's not the smartest way to do things.
Yeah.
Right. So because a lot of people have missed out deals in the past 5 years because cap rate is compressed, right? So the way I do deal is basically, I look at two things, right? One is I look whether the area is gentrifying or not, right? So for example, if you guys know Dallas, right? I think a lot of you guys are looking at Dallas. Dallas has this V shape coming to the downtown. And on top of that V shape, that whole V shape is actually growing like crazy. Whereas below Dallas on the south side, it's not even growing. East side, west side, it's not much growing. So I don't mind taking a more aggressive cap rate on that V shape, right? I don't mind even putting, let's say Dallas market cap rate as a whole is 5 cap. I don't even mind putting 4.5 on that V shape because I know that whole area is changing.
Yeah.
But I can't do it the same thing on the south side, on the east and west, because there's not much of growth.
Yeah.
Right? And the other smarter way to do it is you put a number 50 to 100 basis point and you show your investors, this is the sensitivity analysis. I do not know what's going to happen in the next 5 years, but this is how it might change. So that's, CYA yourself.
Yeah.
Because no one knows what's going to happen next 5 years, right? And you can't say, this is what I'm predicting. And you do not want any passive investor to come and tell you that, hey, you told me this is going to happen, right? If you show them a sensitivity table analysis with varying cap rates, I think you are safe, right? Because you already said that I do not know what's going to happen. Focus more on the cash flow, because cash flow, and also focus more on making sure that you're giving return on their capital, because you have to make profit for them. So people love getting 7, 8, 9% profit every year, right? The back end is juice, is additional icing on the cake, right? So.
No, that makes sense. Yeah, coming from the institutional world, we're always focused on IRR, but kind of what we're syndicating now, we focus a lot more on cash on cash.
Yeah. You'll be surprised. I mean, as you go a lot more into more advanced investors, a lot of them are very smart. You'll be surprised. A lot of people with money, they are a lot more smarter in terms of all these investment metrics. If you're coming to lower level where people are learning how to invest, people who have less money, they may not know a lot of details. You can talk about cash and all that, but when you go into the next level where the bigger money, I mean, people who have a lot more money, they are a lot more smarter in your investment analysis.
That makes sense. Thanks, James.
But look for gentrification of area to justify your own IRR, because, for example, if someone have bought a deal, let's say, for example, in Dallas, in north side of Dallas, right, 5 years down the road, he cannot use the same cap rate as the south side, right? That doesn't make sense, right? Because north side is gentrifying like crazy. South side or east and west is not really growing so much, right? So you want to be smart about it. But as I say, just put a sensitivity table and show the investors. Then I think that's a really good way of presenting your data.
Wow, that's great insight. Thank you.
Yeah, because no one knows. I mean, people just put, I'm conservative. What do you mean conservative? You do not know how to underwrite. Right? I mean, if you say 100 basis point, I'm conservative. Where did you get that, right? I mean, I know a lot of gurus teaches that, but you have to understand a lot of gurus also didn't come from the theory behind commercial real estate, right? How things are being underwritten at different level of the spectrum.
Yeah.
Right. And if you have been in the institutional world, they are a lot more smarter guys. And why they are smarter? And because they have studied all this very well, right? So.
Mhm. Makes sense.
Yeah. Any other questions, guys?
I have a quick question.
Sure.
For that refi event, or just in general, when you're doing refis for your properties at year one to year three or whatever, is that a return on capital or
Yeah.
return of capital?
Refinance and sales are always threshold event, which is considered return of capital. Yes, because now you're returning big amount of money, right? So yeah, you consider return of capital, but you should not treat return your operational cash flow. Usually you want to make it as return on capital, because that's like an interest you're getting. If you're giving somebody 8%, you want to give them a profit of 8%, right? So because that's the right way of doing things. But refinance and sales always been a capital event. There are people who does like let's say 8% pref, and then let's say they get 10%. They say they return 10%. They say 8% is your return on capital, but the 2% can be a return of your capital. That's also is a fair thing, right? But I think if you do the whole thing as return of capital, that means you are not making money, right? This
You're just
the
getting
risk is
back
so
your
high. For investors, you're not making money, right? So, I mean, any investors who get to know that structure, one day they're going to say, hey, I've not made any money yet. You're just giving back my own money.
Right. Well, or like I've seen on underwriting where, it's a value add, but they're giving back cash flow day one. And it's like,
it doesn't, there's no way, right? Even
right. There's no way. That's what I'm
how are you
saying.
gonna give-
that doesn't make sense. It's a
doesn't make
value add,
sense.
and yet you're
Yeah.
giving cash
Well, not
flow.
only that, not only first of all, it's value add. The property is not. Second, you're buying at a 5 cap. You're leveraging at 75, right? That's very, and nobody sells deals nowadays that cash flow 8%. I mean, truly from real estate, right? So what a lot of sponsors are doing, they're creating this illusionary account, which is separate from real estate, but they're giving this illusion that real estate is paying by giving them from day one, right? So it's a good way of enticing a lot of investors thinking that they are getting money from the real estate and keep on investing with them on the next deals. So what's happening is a lot of sponsors are buying a lot of deals very quickly, few thousand units within a few years, by creating this illusionary account and paying them from day one.
So you're using the other properties to pay you? What?
I'll say that again.
So where's the money coming from?
Well, they can overraise it.
They're giving you money back.
Yeah, they can overraise it. I mean,
They're
you
giving you
can come
money
and
back.
listen to my podcast. I asked a lot of details question. Where do you getting money? You said value add, but you're giving 10% return. Oh, I just overraised it.
You're just getting your money back. Wow.
Yeah. But I mean, of course, they don't tell you, right? So I mean, if you are a new investor, I'm happy. Wait, when's your next deal? That's the first thing any passive investor this is really works. Tell me when's your next deal, right? But in a value or even on a cash flowing deal, it's very hard to get 8% cash on day one.
Yep.
Do the math and see. It's very difficult to get it. If that kind of deal is existing, the institutional guys would have grabbed it immediately.
Mm-hmm.
Right. So it's very hard to get a 8% or 7% cash on day one. It takes like 6 months to 8 months to turn around a property to get, right? So, and maybe in mobile home parks, you can do that, right? Because that's a very more cash flow intensive kind of deal. Not much of appreciation, but mobile home, because everybody's already there and they're already paying from day one. But I think apartment is difficult because usually when you buy a deal, you're going to see a lot of turnover in the first 6 months. Right. So, your property will drop first and then start coming back up. Does that answer your question?
Yep. No,
Okay.
thanks.
Yeah. But does that make sense? I mean, do you guys see a lot of people pay, right? 8% day one, 7% day one. I said, how are they doing this? Right. So then later I found out that, so some people said, I mean, people don't disclose it very openly, but people said, oh, it's part of CapEx money that we raised. So, and then there was another guy who I asked, why are you doing supplemental and giving me back 8%? Because he said, I just did a refi and giving me 8%. Why 8%? There's a lot of work to do a refinance, right? You have to work with the bank, you have to do this, you have to do that. So many work you have to do. And you're just giving me 8%. Oh, no, yeah, we are putting money into the rehab budget. So basically what they're doing is they're refilling back the 8% bucket.
Oh, man.
Backfilling.
Come again?
That's
You're
great
backfilling.
insight.
It's not, that didn't really exist.
Yeah. So a normal passive investor, we think that, oh, I'm getting 8%. I'm happy. Tell me when's your next deal. So a lot of syndicators buy a lot of deals because they keep on giving you day one, and people are happy and people thinking, but at some point, let's say the market stopped or they lost out of the money and they're done with rehab. They don't have money to give. And that point, it's going to be a problem. Right.
Wow.
So,
James, I had one quick or a couple questions on the deal you just did. So out of curiosity, did you structure with like a preferential return, or because it's a deep value add, did you just do an equity split?
No, I did a 8% pref with 70-30 split.
Okay. And so I guess day one, the cash flow won't be there, but you'll just make it up as you go.
Yeah, I do a catch up. So I think first year is like only 2%, second year is like 8%. So I catch up the remaining 6% on second year, or maybe at some point, right, refi or sale, but it accrues.
Does it accrue interest as well?
Yeah,
it paid out. Okay.
Yeah. No interest, but whatever is it. Let's say I didn't pay 6% on first year, right? Instead of 8%, I give them 2%, 6%. I can either pay next year or I can pay at the sale, but it's always there.
Gotcha. And then out of curiosity, how did you look at the cap rate on that deal on the exit?
It was 3% cap rate.
Used what?
So how did I look at cap rate?
Yeah, for the exit.
So I didn't look at cap rate because the value add deal, right? So people said, oh, cap rate is too high. This market is too high. But cap rate is basically a measurement of stabilized NOI, right? When you're buying a value add, you're not looking at stabilized NOI. So you don't really look at cap rate, right? So my best performing deal are the one that I bought at 3 cap.
Right. So I understand the going in cap rate's pretty much this, but what about on the exit? What did you?
The exit, I did a like 100 basis point, but I did put a sensitivity table, say that this is what the variation, this is what your returns can be. I cannot predict what's going to happen next 7 years, but this is
so you basically took what you perceive as the market cap rate currently. Don't worry.
Market cap rate and plus 100 basis
plus 100, and then get your sensitivity table.
Yes, correct. Because who can predict what's going to happen next 7 years?
Right.
But
that's why I was curious what you
the entire amount, right? So
you got to do something to generate the cash flow. So
correct.
Got it. Okay. Thank you.
Any other questions, guys? I'm also really good at underwriting. If you guys want to ask
one other quick question, not relating to IRR, but another question on your underwriting.
Sure.
I certainly see it as someone that sees a ton of passive deals and other deals across my desk, and you see a lot more and more folks taking longer and longer IO periods. And so I'd love to kind of get your reaction on sort of building up equity in the property versus using IO to help with cash flow and sort of the blend of how far, especially with interest rates as low as they are. And then, with a lot of folks not wanting to take on, say, agency debt where you've got, prepayment penalties and other issues. So just kind of how you blend or match, the correct financing or strategy for financing on a particular deal to sort of make sure that those mesh reasonably, and how you kind of weigh benefits and downsides, especially on that IO component.
Got it. So the way I did that is on 2018, 2019, I was doing a lot of short-term loans because I know not 2018, 2017 onwards, I was doing until 2019. So a lot of short-term loans because I know the market didn't peak. After 2019, I put all into long-term loans, right? So IO is okay as long as you're using it for value add, right? Don't use it to make that justify the cash to your investors, because once the IO expire, your principal kicks in, and your principal is much larger compared to year one principal. If you do the math correctly, right? It's the principal that kicks in at let's say you have 5-year IO, is a much larger principal compared to year one IO, right? If you see the math, right? So IO is okay as long as you justify it to your investors and you show them the 5-year horizon and show them before IO and after the IO expires, right? But right now, if I have a deal right now, I'd rather do a Freddie floater program with a 1% exit lockout prepayment, because nobody want to get stuck in the long-term yield maintenance issues anymore, right? You can't do bridge loan because bridge loan is too risky, or there's not many bridge out there. But there's a Freddie floater program with a 1% lockout for 1 year. That'll be, I think, the best product right now. You buy a cap insurance on top of that.
Oh, got it. Rate cap. Got it.
Yeah, I think that's the best option right now. The other really good opportunities that's happening in the market right now, which I call the COVID opportunity that not many people talking, is buying a deal on a loan assumption, but make sure you're buying it at a really, really low cost basis. You assume the loan and you refinance, you do a supplemental loan in 3 to 4 years. So that are the deal that I think that's the COVID deal, I would say, because a lot of people are stuck because of the prepayment penalty is so high, but they can sell it on assumption. But when you're buying an assumption, make sure you're buying it at a really good price.
Yeah, the problem with the assumption though is like your leverage is usually really low typically, right?
Yeah, like the deal that I'm doing, it's a 62% leverage. So you have to raise a bit more money, but you justify by saying that you're going to refinance in the next 2-3 years, right? Because once you push up the value add, you can go into a supplemental. Yeah, your leverage is low. You have to raise a bit more money, but that's the opportunity, right? Who can raise money right now and who can assume loan is the winner right now. They are the best guys positioned for COVID.
Wait another 6 months.
6 months, yeah.
When forbearance kicks in really full time, then there'll be even more deal flow.
Yeah, the way the multifamily market crashes is not right now. Nothing is crashing right now, but the way the multifamily market crash is like this. So people have let's say 200 unit, right? So let's say they're out of money right now. They will be starting to move around the appliances from one unit to the other unit to make sure that some units are running, right? So at some point, there'll be too many down units in that property and they got no more capex money. So that's where the spiral comes in. So there are a lot of sponsors out there. I mean, I do a lot of off-market deals and I can see a lot of people who are in trouble, right? So, but nobody talks about it, right? Because the market didn't crash, but there are people who are in a diminishing capital expense advantage position right now. Their position is diminishing on how much capex they have.
Interesting.
So if you guys are really ready for the next 6 to 8 months, be ready with someone who can assume a loan. Be ready with someone who can assume a loan, and be ready with a really good investor base so that you can, assume that loan and refinance out or supplement out in the next 3 to 4 years when the market picks up.
Why wouldn't someone be able to assume the loan?
Well, you need to have a strong track record with Fannie and Freddie.
Mm-hmm.
If one of your deal is not doing very well, they won't let you assume because they say you are in default. You better save yourself first.
Yeah,
So,
makes sense.
Not everyone can assume a loan right now.
Yeah, exactly. No, you're right. Because what you're talking about, if someone's in trouble, they're not going to go start acquiring other properties.
Fannie's not going to say, I'm going to let you assume this big loan. Hey, but you have a problem on the other side, right? So people who are positioned very well in their current property someone who can assume a loan and someone who can raise the money, because the money that you're going to raise is much higher because your leverage is going to be like 65 to 70%, maybe not. I don't think it's 70, 60 to 65%. That means but that's okay because you're getting a really good cost basis.
And you think the reason that people's capex is dwindling right now, do you think that's a result of just non-performing rents or?
Non-performing rents. There's a lot of deals are not doing well. I know people are saying that it's not crashing, but I know a lot of deals are in what you call in deep trouble. They're just sustaining it through, right? Which is still good during recession, but if you look at opportunity as a newbie, that's where the opportunity comes.
Yeah.
Right. So I'm telling all my brokers, low basis assumption deals, right? Don't give me normal deals, because normal deals, there's a lot of people who can look at it, right? A lot of people can buy it, but anybody can go and take a new loan and do it. But there's not many deals which doesn't have a high prepayment penalty. Right.
Interesting.
Make sense?
Yeah.
So
you just have to make sure you can get those deals at a discount though, because if you have low leverage, returns are going to be lower out the gate.
Yeah, returns going to be lower, but you are refinancing in 2 to 3 years, right? So you sell that. You tell your investors, hey, you guys are going to get money back, and who doesn't want money back in 2, 3? Because they can take that and reinvest again. It's like double for them, right? So rather than the boring 5-year cash flow, 8%, 7%, you said, hey, I'm going to refinance in 2 to 3 years. So that's going to be a lot more interesting for a lot of passive investors. I would do that kind of deals all day long because you multiply your equity very quick and you still have your equity in the deal.
Excuse me, James, are you only investing in Texas currently?
Yeah, right now it's only San Antonio and Austin and maybe Dallas, maybe Houston. But right now all my portfolio is San Antonio and 1 in Austin, 9 in San Antonio. Because we are vertically integrated company and we can't go everywhere in the country to go and do. We have to be more cluster based so that we can have efficiency.
I see.
But deals are everywhere.
Mhm.
Right. So, and if you guys want to get my my book for free, let me just quickly share that.
Yeah, put it in the comments.
Yeah, if you guys can see this, this is my contact Achieve Investment Group. Get my book for free for, in here, passiveinvestinginrealestate.com. You have to pay like $4.95 shipping, but it's much, much better than buying the book for $20 in Amazon. Right, passiveinvestinginrealestate.com.
How long have you been syndicating, James?
Syndicating since 2016.
Okay.
Maybe 4 years.
Okay. Have you been full cycle through a couple
The
deals?
first one, yes, we made 332%. But I love doing refinances. That's much better than full cycle.
Could you
Why you
elaborate?
want to sell where you want to sell a golden goose when it's you just refinance and take tax. So we already done like 3 refinances.
Okay. Got it.
And 1 full cycle. 1 means we've gone until sales.
Okay. And you guys are the only GPs on your deals?
Yeah.
Okay.
Only me.
Wow.
Yeah. I mean, you guys can do it too. It just involves a lot of hard work and you have to do things differently from everybody else. Right? See what 99% of the people do and don't do that. Do something else. Like going off market, go to direct seller, so, yeah, if you do things differently from everybody else, you'll be very, very successful. If you do like everybody else, it's the same thing, right? So any other questions, guys? I'm done with my presentation. I don't want to hold on everyone.
Quick question. Are you getting most of your deals through brokers or are you going direct to seller?
In the beginning, when I started, I did direct to seller. But right now, because we are already proven closer, a lot of brokers bring deals to us. But keep in mind, when I talk about brokers bringing deals to us, you need to be in their A list, right? Keep in mind, a lot of newbies are not even in any list of brokers, right? So they do not want to even, unless nobody want to buy, then only they go to a newbie, right? I mean, who want to risk 200, 300,000 of their commission with some new people, right? So if you have done like 1 or 2 deals, you're probably in the D list for them, right? So I mean, I'm not, so don't think that brokers are bad. Brokers are good, but they have their own priority list. They have guys who always buy from them, always sell from them. They make it very smooth for them. They always be in the A list. So the first deal, the good deals they get the A list players always get. That's why some guys are really, really, like for example, Michael Becker, right? Everybody knows, right? He always said, this is an unfair game. What he's saying is, I'm in the A list, right? So it's an unfair game because brokers give to that. So how do you get to the A list is the trick, right? So it takes time to get to that list. And once you go to that list, then you keep on getting deals. So that's why I say a lot of times for newbies, you guys want to look at off-market strategies to find deals. You go around them to buy deals, at least for first deal. Once you do 1 deal, then then brokers will start sending you a lot of off-market deals.
Great. Any other questions, guys?
Any other questions?
Yeah, can you post the link to your book again in the chat?
Yeah, I will.
Please.
All right.
Thanks, James.
Okay.
Thank you, James.
Yeah, this was outstanding. Really, really great conversation at the end of this.
Yeah.
Really appreciate you doing this.
Sure, absolutely.
I'm just going to share a screen here. This is our contact information for our team here. If you want to reach out to any of us, email addresses and contact information. You have James's contact information. Really appreciate him coming on, adding a ton of value, lots of great questions by everybody. And if you all are interested in more networking, we're going to do another set of breakout sessions. Thanks for everybody for joining.
All right, I'm leaving. Bye. You guys can go.
Okay, thanks, James. Bye.